Let's talk about how you might want to structure your business for tax or other purposes today. I'm going to run through some basics to talk about how you can get things done. Now, if you're setting up a small business, an LLC is the most common entity for people to choose, so I'm going to start there. And there's some differences to how that entity can be taxed depending on whether you decide to remain an LLC or make the election for your LLC to become an S Corp or a C Corporation. The LLC has many choices, which is why it's commonly used in business. The most common use is a sole proprietor. You've got a small business, you're making 30, 40 grand a year. It's very simple to set up an LLC and run it. Required? No, but simple. An LLC is a limited liability company. That's all it means, nothing special about the entity name itself. The IRS considers it a disregarded entity when you're using it for your small business or rental property. In other words, they're not going to expect you to file a separate tax return for your LLC or your rental. You're simply going to include the income and expenses on your personal return, usually on a Schedule C for a business or a Schedule E for the rental. Now, for example, if you're a real estate agent or a realtor, you could have your realtor LLC, again, filing on the Schedule C. You report your real estate commissions minus your real estate expenses, subtract out your home office, your business use of your personal car, and that's all getting taxed on your personal tax return. Handyman, same way. Income minus expenses minus your home office or personal auto, the portion that's used for business, can all be deducted and reported on a Schedule C on your personal tax return. If your LLC has a rental property in it, like a condo, then that would be reported on a Schedule E, which is the rental schedule of your personal return. In none of these cases does the IRS need to know anything special, but you should know that the LLC should have a separate bank account, or it's really not acting like a business or the rental that it's trying to run. So we want to make sure that we get it set up properly. Now, in neither one of those cases can you pay yourself any payroll, but you may need to set up payroll if you have employees working for you. Some other considerations: EIN number is optional, but you may want it if you prefer not to hand out your Social Security number. Your bank may ask for it. You might need to get an occupational license if you're a service business, or if you're in the retail business or a contractor, you might need a sales tax license. As far as your bookkeeping goes, any method is okay with the IRS. Save your receipts, get a mileage log, or use one of those apps on your phone. Your home office can be deducted right on there. And for a rental, though, you might need permission from your mortgage company to transfer the deed of the house into the LLC. So we want to be careful to follow the rules in that regard. Now, once your business has increased its sales and its profits are reaching $75,000 or more, you may consider taking your LLC and turning it into an S Corporation, or just setting up an S Corporation directly like mine. You can have an Inc., a Co., PC, lots of different versions of corporation, just different ways of putting the name at the end. Limited is another version. Well, here's an example of what if you have an S Corporation, but you own the building personally. What would it look like? Well, your active business, ABC Inc., or LLC in this case, could run the business, income, expenses, and it could pay you, the owner, wages, or it could also pay rent to you for the building. The rent for the building could go on that second LLC that you set up for the rental if you wanted it, and that would actually go on your personal return on Schedule E. So this is what the IRS considers a self-rental, and this is how I've run my business for many years. The building I own personally, the corporation simply runs the business and I get paid rent. In this case, the state of Arizona won't charge you sales tax since it's considered a self-rental. The business does all the normal things a business can do. It makes an election as an LLC to be taxed as an S Corp, or you set up a corporation and you elect to be taxed as an S Corp. Either way, it's just an election. It's paperwork that needs to be filled out. Now let's take a look at the S Corp itself. The S Corp has business income, expenses, maybe rents it pays to you, and wages, which are required to be paid to the owner if there's a profit. And you're taking money out. If you're not taking money out of the business, you don't have to pay yourself wages. The S Corporation tax return is due a month early from your personal return, so be sure to get that thing filed early. It's due March 15. The S Corporation itself pays no tax. The profit from that business flows over to your personal return through a form we call a K-1, and you pay tax on it. Well, what about those distributions you're taking out? The IRS doesn't care 90% of the time. Only once in a while will those distributions be taxable. You're going to be taxed on the profit whether you take it out or leave it in the corporation, and you can be taxed on your personal tax return. So we want to make sure that we're prepared to pay taxes from that S corporation personally. Asset protection, it's possible to get a little bit of asset protection from the corporation, but we recommend a couple of things. One, workers' compensation is the best insurance you can get. If your worker is injured on the job, he can't sue you, he can only sue workers' comp, the insurance company, to get paid for that injury. Our suggestion is buy insurance. That's the best way to protect your personal assets. If you're a professional like me, you want to buy professional liability insurance. If you have a business location like me, you want liability insurance in case someone slips and falls or has an accident within the building, parking their car or stepping out of their car, whatever can happen. Tax benefits. All business income and expenses for the LLC are taxed on your personal return. However, the IRS says that profit is reduced by 20%. 20% of your profit is tax-free. Guess what? No profit, no tax deduction. So make sure your business is showing a profit. That's the whole reason to run a business after all. Now, some businesses are limited in the amount of this QBI, this business deduction, that they can take. If your personal return, your income is $200,000 or over $400,000, you may be disallowed from taking this deduction. This is focused at preventing doctors, lawyers, accountants, entertainers, and athletes from getting this particular deduction. If you're a contractor, no big deal. You're going to get the 20% no matter how many millions of dollars you make. Finally, the business owner is required to take a reasonable wage. We'll help you calculate that through some software we have and set that up for you for your business. That way the IRS can't come harass you later and say, where's your paycheck? You didn't take it. Now, can your LLC own another LLC? Certainly. You could have a parent LLC own another LLC that runs location 1 or location 2 of your business. We have a client with 15 locations, and each location has its own LLC. And at the top, he has one LLC that owns all 15 locations. So the bottom locations are typically partnerships because he's splitting the profit between him and 1 or 2 other partners who may be involved or not involved in the corporation on top. Not a bad structure. This is a little more complicated. However, it does let you keep track of the profit of each location and divide profits up differently based on who the owners are between the locations. In case you have an investor that invested in location 1, but not in location number 2, or perhaps your brother-in-law is the manager of location 2, and you want him to share in a percentage of those profits. Again, taxes are going to depend on how you've got the structure and who's receiving money how. But this is not a bad thing at all. Are there some restrictions to your S corporation? Certainly. Your S corporation generally has to be owned by people. Owners must be humans. A living trust is okay because it simply passes the income through to its owner. I do this on my return. And if I died, my estate could be the owner for a short period of time until either the business is sold or my children take over as the shareholders of the LLC or corporation. Now, people that can't be owners are non-residents of the U.S., corporations, unless they're set up as a qualified S Corp subsidiary. LLC partnerships cannot be owners of an S corporation. 401ks and retirement plans cannot be owners of S corporations either. But you know your 401k and your IRA can invest in stock on the New York Stock Exchange. That's because all of those are C corporations or partnerships. That's why those are different. Now, once your business profit hits $250,000 or up, you may consider the need for a C corporation instead of an S corporation. Or you may continue with the S corporation if it works fine for what you're trying to do with your business. It may depend a lot on how big you plan on growing or how well, or if you perhaps want to bring some of your employees in as shareholders, you may benefit from one versus the other. C corporation, for instance, makes it easy to create an ESOP, an employee stock ownership plan. How's it look? Well, C corporation is kind of a self-contained entity. It has its own income, its own expenses, and it pays taxes to the IRS at 21%, and Arizona, if you're in my state, at 3 or 4% based on the income. Your personal return doesn't get taxed on the profit of the business, so it separates it from you. If you're in a high tax bracket, 34 or 37%, this might be a good choice for a couple of reasons. However, dividends that you take out, or distributions if you want to call them that, are going to be taxed on your personal return. So if your plan is to spend all the money, a C corporation is probably not the right choice for you. But if you want to segregate the business from your personal taxes, the C Corp might be the perfect choice. If you're planning on going big, you're going to grow to 1,000 employees or a dozen locations in 14 states, a C corporation might be a better choice, especially when it's time to sell the business or get bought out by a bigger corporation. The other benefit is you can have foreign partners. If you desire to have a foreigner as a partner in the business, this might be a better choice of entity for you. Finally, something a little more off the radar, a family limited partnership. What is this thing and what's it trying to do? Well, a family FLP or family limited partnership is designed to put your personal assets inside it and contain them and then protect them from your creditors. So if someone were to sue you, they couldn't get access to the assets themselves. You would become a limited partner of the FLP, meaning you have no say in how it's run or what happens to the income. But you would pay taxes on your personal return of all the income, 99% of it usually, of the FLP. So you're not getting rid of the income tax bill here. You're trying to protect your assets from lawsuits. So for instance, my dentist uses one of these FLPs. The FLP owns all of his personal assets to give him asset protection. And he has this little C corporation that owns 1% of the FLP. The 1% gives the C Corp a tiny bit of income. It manages the FLP, and it helps protect those assets by refusing to take money out of the FLP and giving it to your creditors, or if someone were to sue you, giving it to that person. A way of protecting the money that comes out, or perhaps forcing them into a settlement. This is a much more complicated solution for how to run your business or assets. It requires a lawyer to set it up. You might need a deed from the lawyer to help put your real estate inside this if that's the goal. And there's some additional filing costs to having a structure like this. But we have several of our clients that have used these things successfully for years and swear by them. They're happy with the results they get from this structure for their business and personal needs. Thank you for taking a look at what we have to say. If you have more questions, please set up an appointment to speak with us personally. I'm David O, a CPA. Thanks.